live stream. This week we've got Douglas Dowell, and we're going to be talking about all things real estate. We're also going to address the controversial remarks made by Mike Radzicki last week on the show. Be kind, stay safe, and enjoy the show.
Taylor Swift to endorse my hammer.
No! God, please, no! No!
I'd get Taylor Swift to endorse my hammer. Taylor Swift, Taylor Swift, Taylor Swift. To endorse my hammer. To endorse my hammer. To endorse my hammer. Oh, I didn't even think of that. Come on now. Oh.
I almost can't begin a show with that. Like it obliterates every prompt that I have in my head to introduce the show, especially one on real estate, right? I mean, how can you go from hammers and Taylor Swift into real estate? Oh man, we're going to try. The title is The Model of Real Estate. Is it the model of real estate, or is it more of a critique? I don't know. We're going to have you stay tuned and tune in and watch the show and find out. What I'm going to do right away is I'm going to bring in my comrades here. First of all, I'm going to bring in Steve and Mike the Hammer. Oh, we got Douglas instead. Okay.
Bring it. Okay, where's Mike?
Oh, there's the Hammer. Hey, Hammer.
You've gone from being the hammer to being hammered.
Yeah.
Yeah,
Be
where's your
careful with
monster
the fingers
drink?
you put up there, mate. We've got to make sure you use the right one.
Oh, I do. I got a clear one today, but yes, I got one.
Okay.
Yeah, that whole thing was kind of, to me, sort of a Rorschach blot test of what do you see or what did you hear? And it reveals what people are kind of thinking.
Oh, it's all their fault. It's all in their dirty minds, is it? You know that joke? I've forgotten. We've got them for complete details, but a guy's going through the Rorschach text, and he's shown something. So that reminds me of sex, and reminds me of jiggy, and something else. And finally, the psychologist said, "Look, God, you've got a dirty mind. So it's not me. You're the one showing me the dirty pictures."
Dirty pictures. That's right. I love that.
Yeah, well, the double play on meaning with the Rorschach thing is like it looks like asymmetry, but it isn't. Right? No, I love that double play on asymmetry. It's an interesting thing. I look at it as more of like a door that Mike walked through, right? Like it was
before he opened it, you mean?
He just burst into the party where you couldn't not say that, right? Like anyway, I don't know if it was like some underlying thing that we were all thinking about. It was just that's what made the humor so funny. I think that surprising smack in the face, right? And it caught. So and when you walk into it, right? You know.
Till the moment everybody started laughing, I had no idea. Then suddenly I'm like, I walked into that one. But
Yeah. Okay, well, which of the two of you are going to read the top chatters list? That's what I would like to know.
Well, it's got to be Mike, and if he says a hammer at any stage during the whole thing, we've got to take him out and give him a good beating.
Okay, here we go. Mike, it's up to you. You got the chatters list.
Right, okay. Mervyn Hyde, Carl Smith, Wyndham Estate and Managed, O Dependence, Alex T, Bruce Constantine,
Justin, Raj, Anthony, Tiffany Hart, Economics in One Lesson, Tony Wilson, Post-Crash Economic Society, Gunny, 1972, John Watson, Ghost on the Half Shell, Philip M., Nighthawk Williams, The Real Charlie Bucket, Mouse Envy, Lana Dell Hates the Clock, D. Smith, Johnny, Positive Economic Reform Ideas, Mad Max, TR, Step Aubin, Sale Stiletto, Creative Global Funding Services, Mandy Morehole, BWNSP-TV. All right, Stephen Hinton, Acu Music School, Connor Howell, Boy Howdy, Winston Redford, Annette B., Larry Summers. Hi, Larry. Morningal, Manharan, Murphy, Multi-Euro X, Political Economy 101, Steve Frith, Bob Liori, Botch Mandela, Christian Watkins, Murray Krause, Gua Badart, Patrick, Drygay, Rick O'Brien, Andrew Green, Brownie 003, Matthias Seden, and Igor Insanic.
Good one. Good one. Good one. But
there we are.
It's a creative experience, I suppose, that we're glitching out. But
I'm noticing. What's nice about reading the names is there's a lot of folks who join us every week, and you kind of know the names after a while, right? So that's a good thing. Right?
I was going to point that out. Like our reading and pronunciation of them, there gets to be a bit of a familiarity, right? So the lesson there is like, keep coming by, we won't butcher your name, right?
Yeah. And David is here.
Unless your name's Taylor Swift.
Yeah.
Oh, that'd be great. That'd be
Taylor
great.
Swift thing is going to linger for a while. Jovi and I.
Yeah, I
okay.
think so.
Where's Ty? He's lurking in the background, I guess, right?
Yeah. Taking a social media hiatus, he said.
Yeah.
So that's.
I don't know if it's a steady stream of comments coming in, but in the meantime, let's bring Douglas Dowell, our honored guest, into the Steve and Friends ecosystem here. Douglas.
Good morning. Good morning, guys.
Good morning.
Yeah. Whereabouts are you for the audience?
I'm in Wheat Ridge, Colorado, which is a Denver suburb.
Oh, okay. Steve, have you ever been to Denver?
You've seen one American city, you've seen them all. Ha ha. I don't think I actually have been to Denver. I could be wrong because back in the days when academics traveled to conferences regularly, I did a fair bit of flying around the states. I think I would have actually made some comments about Rocky Mountain High. So I'm guessing I haven't made it to Denver.
Oh, okay.
Utah, I've done quite a few times to Utah. Phoenix, Arizona. I've even actually been to where's the song "The Man Who Shot Liberty Valance"? I've forgotten. I'm really showing my musical age here. But I've been to the. Huh?
It's a good movie.
You sure? I thought it was a good song with a bad movie. I'm not really sure. Anyway,
some preferences.
I've got to think of I met the Gore-Tex family, the family that made the Gore-Tex material, and they are in like one ridiculously remote town somewhere in Colorado, I think. And so I ended up, and they actually had a post-Keynesian economic advisor, which I was quite impressed by.
Yeah. Mike, what about you? I mean, this is a lot closer to your hood.
Everything's relative. I'm not sure that Massachusetts is close to Colorado, but I've been to Denver a couple of times. The System Dynamics Conference was held one year in Keystone, and we went through Denver on the way there. And one year, one of the institutionalists, Western Social Science Association meetings or something were held in Denver. So I've spent a little bit of time in Boulder, being an academic, over at the university, which is kind of a neat place. So Colorado's cool.
Incredible place.
Douglas, I got a question for you that'll kind of bring everybody up to speed. I would like to combine your thoughts on large funds, because you're a fund manager, I believe, and then also real estate. So there's a different. I mean, you're not a real estate buyer per se or by profession. So you're a fund manager. Maybe you could explain, how you look at the market, what you think of real estate. Kind of, give us your thoughts on that.
Absolutely, guys. My background was coming up. I was like practice law or investment banking. So I took the practice law gate, and then also got really involved in almost all of my career is involved in real estate in one shape or form. So essentially became a fund manager at the end of kind of toward the later part of the career here too. We basically help busy people invest in real estate. So we partner good operators with good investors. Essentially, is what our role is, and so we're more on the smaller scale. I like to say Wall Street strategies for Main Street. I'm not a particular fan of Wall Street, and I'm sure we'll get into that in the show and how I'm here. But essentially, taking the opportunities that Wall Street uses and abuses and helping Main Street to win with those.
Wow, that's really interesting, a Main Street approach versus a Wall Street approach. I say we jump right into that. And what do you see as the problems for Wall Street?
Well, I think the great one is the 401k structure. The 401k is really rigged for the big institutional companies to basically manage your money. And can you leave and do what you want with it? No. Well, the fun thing is if most of the plans you can't do this, but after you leave, you can start self-directing your 401k into real estate, into metals, crypto. God's sake, please don't do crypto, but that's just my personal take. But you can do anything you want with your 401k, and most people don't realize that. So that's one of the things we advocate for is, taking control of your investments and understanding, hey, they're not your friend. They're not here to help. They marginally, and at best, if you do the historical research on fund managers, even being a fund manager, I have to tell you, the track record of active management is terrible. And I'm an acolyte of Warren Buffett and Charlie Munger, and I think that's really colored my viewpoint. When I found Charlie and Warren, I'm like, okay, I can actually, advocate for things I believe in and also serve Main Street, and that's pretty much what colors our thinking.
That's really interesting. I like that little side plug, or I guess like stay away from crypto. I'd like to have Mike and Steve both weigh in and give the audience their thoughts on crypto. Very briefly, in a sentence or two. Let's go with Mike first.
Interesting innovation. I think the blockchain has lots of uses besides crypto. That's probably in the end what the big innovation is. It's great for transferring funds. Obviously, the privacy thing is a big deal. Is it really a currency? Not certainly according to modern monetary theory. It's here to stay. Digital Fed coin is coming probably at some point. So we're in the digital world.
Steve.
Well, first of all, I regret not taking the advice of Max Kaiser and Stacey Herbin and buying Bitcoin when it was about a quid each, because I could have afforded to lose I think about 5 quid, something of that order. I could have afforded to lose 1,000 quid, and I would have made a couple of million. So a big mistake not to jump onto it. But as soon as I heard that the way that a block was verified was to have a random number generated with a whole sequence of zeros, what they call a nonce block, and that takes 10 minutes of computing time times how many people are bidding to produce it. I thought this thing is a hiding to nothing to be destroyed as soon as we have energy shortages being imposed on us. The easiest way to reduce our carbon dioxide footprint in a hurry would be to ban Bitcoin. So I see it as an electronic tulip. And I regret not getting on the tulip. I would have been made my financial situation far easier. But it isn't money in the sense that the essential function of money is to enable transactions. And if you have something which is appreciating in time. So there's a story of the bloke who paid 100 Bitcoin to buy a pizza way back in the early days. Now regrets buying the pizza. So if you have an appreciating object you're buying things with, it encourages you not to buy. And you hang on to speculate and hope that it's worth more in the future. And that is the way in which people talk about a means of exchange, a means of account, and a store of value. And the store of value is the problem. The best form of money, as Gazelle pointed out many, many years ago, is a money that depreciates. If you don't spend it, you lose it. And that then encourages economic turnovers and so on. So Bitcoin is the opposite of that. and but I'd never thought it had reached the heights that it has. And I would, I hope I get a chance to watch it come crashing down, and maybe that's either before or after it gets banned.
There seems to be an underlying like anti-government, organic anti-government sort of like feel to it, right?
Well, that's a large part of its appeal. Yeah.
Yeah. I was going to say the Venn diagram of Austrian bros and finance and crypto is almost like it's just a circle. It's not a Venn diagram; it's just a circle. Yeah,
that's true. Yeah, 3 donuts laying on top of each other with a hole in the middle.
Speaking of speculation, Doug, how susceptible are real estate markets, whether commercial or residential, to speculation and bubbles?
I really love that question. I think right now, I think real estate generally, and just take a big overview first and then kind of dig into where we're at versus 08. I really think multifamily right now, for example, is really seen, and again, it comes down to what Steve has been on for a long time, is that debt is what's driving any speculative bubbles in real estate. It's not really the real estate itself, I don't believe. It's more the debt that drives that, and we see that in multifamily right now, and it's really a mess. Back in 2020 and 2019, there was a bunch of non-bank financials and some banks, I'm sure, but non-bank financials that are issuing bridge debt. And what that is, it's a 3-year or 4-year or 5-year at most loan at 3% or whatever. And guess what? Rates are up here at 6 now, and there is incredible distress in multifamily right now. I think it feels like the prior distress in multifamily last cycle is it's going to kind of work itself out. But needless to say, we're starting to see foreclosures, starting to see real problems in the multifamily sector. And I'm also very curious why the Fed's reluctant to drop rates, and we can go here on a different tangent here lately. I think they're completely wrong for not dropping rates already in my take. And again, I am talking my book probably. I have a vested interest in them dropping rates, but I really do stepping aside from that. That really.
Yeah, I like that. I like that. No, and keep in mind, just as the audience knows this, but you may not, I jump in and, basically just to bring back the nice illusion of the pub, right? We kind of just throw, because I want to get this guy involved. I don't even quite understand what a synthetic derivative is. I don't understand the question, actually. Maybe. Right. Maybe you can help.
Yeah, and that's why I recommend everybody should see The Big Short. They do an incredible job of taking a very complex topic and really breaking it down. And so what happened in 08, part of the problem is, and I will tell you, back in 98, I was sitting there cheerleading in the halls of Washburn Law School. Okay, hey, great. We're going to repeal Glass-Steagall. This is great. One of the worst things we've ever done. We repealed Glass-Steagall that prevented risk like that from being piled on by creating separation. And I have to say, the regulators, God bless them, they're a fraction of the market. And also the market moves faster than they do. So to get to the answer of what a derivative is essentially, it's not the underlying product, it's a interest in the product. And so what happened in 08, they kept piling risk upon risk upon risk. So they're adding, and they're probably leveraging up most likely at each level. So that's why the 08, it wasn't the mortgages necessarily that were the biggest problem. It was the synthetic and the derivatives that they kept creating through financial engineering that really became just toxic and really was a large part of the problem.
Can you give me an example of what the derivative is outside of the low rates? Because I mean,
sure.
Just the subprime mortgage is what heuristically locks into my brain for the collapse there.
Yeah. And essentially, the first step is we take all these mortgages and we bundle them up, and we say, well, let's we'll stack these mortgages together and then we'll sell them off, because larger capital doesn't want to have to individually pick them out, so they want easy transactions, so they buy a bundle. And so in that bundle, we have a bundle now. We have a nice bundle. Well, some creative people, we'll call them creative at this point, decided, well, I want an interest in that. And then they started, selling interest and insurance on them. So there was default insurance. And well, somebody else was on the other side of that. And then, okay, well, let's pile on some more risk and we'll have interest on the interest. And so they kept creating more layers, and it got really stupid. And I didn't even realize at the time how stupid it was. And then you watch The Big Short, they did a wonderful job of, guys, they got crazy.
The basic idea is that you have, you've got a mortgage originator. So somebody goes around and sells mortgages to 1,000 households, let's say. And then the derivatives are created by saying, well, let's bundle those 1,000 households together and call it a collateralized debt obligation, CDO. I'm not sure I'm getting the right terminology right because it's ancient history now, but that's the idea. And so you have 1,000 mortgages, and then you rank them in terms of the credit rating of the people who've taken out the mortgage from the very highest level right down to the very bottom. And then what you then see, you sell them in tranches. So you can say you can buy the first tranche, and that means the ones which are like 5 standard deviations above the average in terms of reliability of repaying. And then down the bottom, you've got 5 standards below. And so they would have prime mortgages, median mortgages, and subprime mortgages all bundled into one and selling different components of it. And it was, and what they argued was that by distributing the risk, we got rid of the risk. Okay? So, we spread risk everywhere, risk disappears. Isn't that wonderful magic?
No,
and
right.
I know one person who fell for that was Janet Yellen.
And the crazy thing about it, Steve, it just drives me crazy too. It's like, we're going to sell you a 9% mortgage that resets in 2 years at 11%. Oh, and by the way, we didn't underwrite your income. We no income, no job was the joke. It was the ninja loan. And it's like, what were they thinking? And this is the core, and the kind of why I'm even in this room and how I got here, frankly, is this is the beginning question was, well, okay, what were we doing and why was that okay? And frankly, I was a free market guy in the 90s and 2000s, early 2000s. I'm like, free market solves. Does it?
Yeah.
So just to put a little bit of a personal story on this whole discussion, when I bought my first house in 1985, I was a newly minted assistant professor at the University of Notre Dame. And I went to my local bank and my wife and I had to go before a loan committee. And this was like literally a dozen, I think it was all men at that time in suits around a conference table. And they interviewed my wife and myself and they said, we'll let you know. And then I had to go back, or my wife and I had to go back, and we found out we were given the loan and we were given kind of a lecture that kind of like, you're young, but we value the fact that you're a professor at a well-known university, so we trust you and whatever. And here's the point. They made the loan to me, but they serviced the loan. They did not bundle it up and ship it off to somebody else and spread the risk. So they were very careful about who they were lending to. And as soon as this bundling and selling, now your mortgage is serviced by this other bank, so start sending your checks here, you get those periodic things. That started the downfall, I think, of the housing bubble and crisis that we had.
Completely agree, Mike. And one of the problems in Wall Street is, and this was again, Michael Lewis did a good job in unpacking this profile. Wall Street stopped having skin in the game. So the bank there, they still had skin in the game, and Wall Street was, we don't have to do that anymore. We can just, ship this off, and it doesn't hurt our individual outcomes if we did that. And that was the real root of the cause of the problem, is there was no repercussions and still hasn't been.
No repercussions. That's really fascinating. So, and this shift to Main Street. So tell me about a couple projects or some things that you're proud of that actually ended up on Main Street.
We're working on it, and this is fairly new business for me, so we're still in the early stages. We love ground-up development. Part of the big problem in America right now is in 2008 that the developers got crushed. So we have a lot of we never caught up in terms of supply. So we're trying to do what we can to raise money for development deals, build to rent, any construction deal. We really like build to rent, though, and we also do commercial real estate debt for spec home builders also. So we've got those two things that we work on to help the problem.
What's a build to rent?
Oh, so it's interesting. One of the innovations, I will say, in real estate, this is, everybody's always kind of done this a little bit, individually, but now we're building single family homes for the sole purpose of renting. In that housing affordability is really tough. It's been a 3-year trend really where it really got hot, where we're building, 55, 100 units of single family just for the purpose of renting it out.
Interesting. As a side note, I'd like to pull you aside after, because I'm in that I have some really specific questions for you.
Sure.
Mike,
Yeah. So,
Like
so
what?
Doug, do you view that as part of this apparent trend where big funds like BlackRock are buying up residential houses left, right? Some say it's part of the Great Reset, where you'll be assigned a house at some point, and other people say no, it's just an opportunity, like you're describing, to rent to
Yeah.
folks.
Yeah, thankfully the market's way too big for them they can be a problem for sure. They have enough capital to be problematic, but if you look at the research, I'm not as concerned about that. What I'm concerned about is the wicked supply constraint. And again, people are talking about, oh, there's a bubble. Real estate's going to crash. I mean, you got that prior. It's the old prior cycle that really messes with your head, right? And people are like, oh man, single families are about to crash. It's like, if you look at the equity in the homes and the supply constraint, there literally is impossible for a crash right now, almost. And it's kind of interesting to see people how it's affected their psychology. So single family, the problem is we just need more supply. We're literally like a million to 5 million units short, depending on who you talk to. And so that's a really interesting problem that we're facing right now.
Is that agreed upon by you guys? Mathematically. No, I was going to talk about Mike and Steve there, right? Like,
Yeah, look, the supply is always rigid in real estate, and people talk. I mean, they reduce it to supply and demand. It's end of any sensible discussion, because it takes so long to build a house that you can pretty much regard the supply of housing as fixed. But what therefore causes changes in the valuation of houses is changes in demand. And where do the changes in demand come from? Fundamentally from borrowed money. You have mortgages. That's why I identified the housing was going to have a crash. And certainly in America, I was right, and most of the rest of the world. Not in my home country, because I scared the pants off the bloody government, and they then did work to preemptively stop the bubble from crashing. But when you look at the demand for housing, that is fundamentally new mortgages. So new mortgages effectively a change in the level of household debt. That's the monetary demand for housing. Then you divide that by the average price of housing, and you get how many physical homes can be created, both going to be purchased, given that that combination of new mortgage debt, which is the monetary demand, divided by the average price level. So you then got a relationship between change in mortgage debt and the level of house prices. And out of that, you also get a relationship between change in mortgage debt and change in house prices. And here I've got to point out a bit of cowardice on my behalf, because I worked all this stuff out, did the mathematics of it, and it argued that there'd be a relationship between the second differential of mortgage debt and the first differential of house prices. And I did not check it, because I thought, shit, logically I know it's going to be there. But we're talking a second derivative and a first derivative of quarterly data, which is incredibly chunky. And I thought, it just won't turn up. And I'll embarrass myself by finding it doesn't turn up in data. Well, kick me in the bloody ass, because I've forgotten who it was now, an English researcher, went out and did what I should have done and found an incredibly strong relationship. And now when I look at the relationship between the change of household debt and the change in house prices, correlation coefficient's up at the 0.6, 0.7 level when you're looking over 30 or 40 years of data. So it just screamingly says, yeah, you're right. What drives house prices is a change in mortgage debt. And when people come and say it's all about supply, give me a break. It's all about controlling the amount of money that banks will lend for housing. That's the real problem.
Yeah. So from a system dynamics point of view, we have a bunch of real estate models that we teach and use, and you get a boom and bust cycle often in the real estate market, or a market where you have a long delay on the supply side. So demand changes, demand goes up, and then the supply side responds, but it takes so long to plan, get permits, build, and whatever. By the time that new supply comes online, demand has changed. Now you have an oversupply, and the market swings the other way. So it's kind of a generic structure for why any system will oscillate. But the sort of the generic idea is, on the supply side, if there's a long delay before supply can catch up to demand, often when it gets there, it's not the right amount anymore because of the delay, and it's likely to have a cyclical behavior. And we see some of our viewers commenting about the cyclicality in these markets.
Yeah, Steve. I have a question for Steve. The confidence of 6 or 7, 0.6 or 0.7 in that statistics. Why? Explain what that is a high number relative, and what that actually means, based off of what
Well,
you were.
yeah, as the R squared is about 0.6 or 0.7, the correlation coefficient is about 0.8. And,
Oh,
and
0.8.
what the reason it's a strong statement is that according to conventional economic theory, it should be zero, not significantly different from zero. So if you believe mainstream bullshit, and unfortunately far too many people do, it tells you that people are buying for the net present value of whatever they're purchasing in terms of the asset. They look at the income stream over time, and that's what they take a look at. And it doesn't matter how geared you are. They'll say that the gearing is unimportant. What's called the Modigliani-Miller hypothesis, one of the many pieces of bullshit they teach in finance schools, says that
Yes.
because the person buying an asset can be levered and the asset itself can be levered, it's quite possible for a highly levered person to buy a lowly levered company or lowly levered asset, and equally possible for a very lowly levered person to buy a very highly levered asset. Therefore, overall, level leverage is unimportant, will have no impact upon data. Well, they're red rag to a bull for me, because I'm so used to, I just know this stuff is all based on ludicrous ideas about people being able to accurately predict the future. That's what the efficient markets hypothesis is based upon. We assume you can predict the future. Now we check how the market's going to operate on the assumption that all the investors are predicting the future. So I take a look at it, and like according to said, the standard argument is your correlation should be not significantly different from zero. When you find it's 0.8, don't call me weird, but I think 0.8 is significantly different from zero when the maximum point is 1. Yeah? So this keeps on happening in economic data. And as I've often told when I was teaching my students, I would not dare make up artificial numbers that are as strong as what I find in the actual data to contradict mainstream economic thinking.
Yeah, it's evident. It's evident. Douglas, I'm going to give you a chance to jump in here just before, but it's that time in the show where I got to remind everybody to like the show, comment in the comments, engage, follow Steve on over there on Twitter. We're on LinkedIn. We're live on YouTube. So set the reminder bell and come on back. And we love you all for joining us here every Saturday. I have to say, now this might be a little bit of make Steve blush a little bit, but that was a really great explanation. And I think, anybody that's seriously interested in money, and that's how wide this net should be cast. If you rewind what Steve said, and you want to be serious about having a competitive advantage in the market, in markets, is he not compelling? I mean, at least to know, you may not agree with Steve, but that's up to you. And he's putting a lot of juicy tidbits out there. So, thanks Steve for being Steve. And, let's go to the guest. Douglas, where's your mind at? Do you want to?
Well, I love that last point about, and again, the part of the challenge of being a successful developer in California is it takes 3 to 5 years to get anything significant done. In Texas, you show up and say, hey, y'all mind if I build this? Go on ahead, sir. So essentially, you have these wide ranges of entitlements. And again, so I think that's a core problem with our cost structure right now is California seriously is ridiculous. Now, they are working hard on reforming, but the reforms are slow. And so essentially, and I also take Steve's paper on commercial real estate. I remember, Steve, you mentioned it, like a mid-90s commercial real estate paper you did, where you don't want it to be too fast because you need time to update your model. So essentially, one of the problems in development is it's like Gretzky, because we have Canadians really driving the show. We have to give props to hockey, and Gretzky is you're skating where the puck is going and not where the puck is, and so you have a signal problem when you're doing your feasibility. You're like, well, the signal right now is good, but it takes 18 to 24 months, depending on how big your project is, to get it actually in the system. You're taking a lot of decisions under uncertainty, and that's. And again, I really appreciate what you're saying, Steve, about the finance side of things. They're screwed up as economics in the mainstream. So it's a pervasive problem, and I agree with what Dan said. If you come to this show and you're listening, you do trust me. You're getting cutting edge, the no BS story, and if you want to follow and be very successful financially, you're in the right room.
Actually, Mike, you'd quite like the paper that Douglas mentioned there. I read it with a guy called Max Kumaro, And Max was an academic in Curtin University in Western Australia, specialising in commercial real estate. And he showed me what he's getting in terms of the data and the cycles he was seeing in commercial real estate prices. I said, I can make up a model to simulate that for you, which I did. I think it was done at a difference equation rather than continuous time, which made sense there because of the extremely large time lag that existed. And I showed that if you wanted to get rid of the cycles, you actually need to increase the time lag in approval of new programs, and that would lead to a more stable outcome than approving them rapidly, which is a weird result, but that's what came out of the model.
So I have a question for Doug. You mentioned Warren Buffett and Charlie Munger earlier, and of course they didn't like Bitcoin either very much. Charlie Munger in particular, and he just, of course, recently passed.
Right.
But the traditional original Warren Buffett method was Ben Graham, right? Value investing, which is you find mispriced companies, right? Usually like in a bear market, and you buy them, low, and then eventually the market figures out what the price should be, and you make money. And Warren always said that Charlie changed his mind on that, and you want to buy good companies at a fair price, not necessarily at a bargain price and what have you. So how do you apply the sort of the Munger Buffett approach to invest in? They were equities usually to real estate, if that's what you do?
Well, we really appreciate that. And my big picture thing, first and foremost, I think the value system is really challenged by information. Information is so readily available that I think value investing, the Buffett original style, is really hard to do now. I think if you wanted to go play in China or some random weird market, you probably could do that. The American market is so, and this applies to real estate, pretty much anything in American market. So what we really are is much more the Munger style of like, well, we won't overpay. And trust me, in real estate in the last 5 years, there's been such a, I loathe to, this is a family show, so I'm loath to use this word, but there was an orgy in greater fool theory. And you come in, well, okay, I printed a new syndicator. He's raised money from grandma and grandpa, and we're gonna pay even higher price that doesn't make sense. And so, really, we're seeing the Warren, back to the Warren quote, is like, when the tide goes out, we're gonna find out who's swimming naked. Unfortunately, there's a large number of multifamily syndicators that are swimming naked right now.
Is this the actual people producing the instrument, or is it the houses that are people who are buying the houses?
Yeah, so this is on the commercial side, multifamily. So what essentially it is, it's like a small business raising money to buy the building instead of buying a business or starting a business. They're raising money and buying the commercial property.
Okay, and then they rent that out to multiple families.
That's right. And they raise money on Main Street, and they buy a bunch of multifamily. And again, it's a smaller deal, so it's 2 to 5 million, somewhere in that range. And that strata up to I'd say 7 to 10 million. You see a ton of people on Main Street starting a business, which is a great model overall. But unfortunately, the financial and the risk acumen of that crowd was terrible, and they're getting crushed.
All right. Okay.
So Doug, would you advise anybody right now in terms of you mentioned your personal 401k, a personal investing IRA or something, to take a look at commercial real estate, or due to the pandemic and Zoom and all this stuff that's no good anymore?
Great question.
I personally think it's a really crazy situation too, because the demographics are fantastic for multifamily and for really any housing product. It's wonderful. So assuming the debt structure is correct, it is a wonderful investment. And that's the kind of the phase we're going through, is some disruption in the multifamily market. I would say in the next year to year and a half to 2 years, we're going to see some it's going to have to come out. The laundry's going to have to get cleaned. And I think, assuming you get a good operator that's got proper risk management. And again, one of the things you could have done is you could cap your rate also. So the risk savviness was not there, and they didn't cap their interest rate. And the people that capped their interest rate, or there's some really old wise syndicators that were in the last cycle that did a longer term debt and got fixed pricing on their debt. And so those guys are sitting pretty right now. So you find the individual that was wise enough to do that, that may be good to work with in your 401k and in terms of investing in commercial real estate, because I am very bullish long term demographics wise.
Okay, so it's better to put my money into a real estate investment trust or an ETF that is real estate based, rather than going into my city and buying a triple decker or multifamily dwelling and trying to make money that way, or potato.
I personally, the problem with REITs is they behave more like a stock than they do real estate. So again, if you have a long horizon, you just want to set it, forget it, absolutely, a REIT's fine. One of the benefits of the Main Street, and this is what drives a lot of what we're doing, is the depreciation benefits are wonderful for a Main Street real estate investment. So if you have a high income, one of the main reasons that this market exists is to help share that depreciation benefit. And if you have a lot of income, that's the main reason you would want to do that versus a REIT. The tax outcomes are way different. So.
Okay, good. I didn't think of that, but that's a great answer. Yeah, thank you. Yeah.
And I would add, Mike, I'm in the similar business, and investors don't have the experience to run construction projects. It's not intuitive for an average person. So I would say make sure you have enough wherewithal to understand that whole construction process, right? Because I think we talked about earlier in the show, it's like these are 2-year, 5-year builds, right? They're a big chunk out of someone's life. So whereas I think a pooled product, right? Like a pooled product, like what you're talking about, means they're hitting all at the different times. And so as you enter into the fund, you don't start at the beginning of the roller coaster ride. You get to come in at any point in the circle, basically. Yeah. So.
I want to check about people like BlackRock getting into buying real estate, because that's a post-financial crisis phenomenon. They were creating the instruments on the other side. They weren't buying. Now they're buying. And one of my little hypotheses is that quantitative easing, which Bernanke, I really should call him Bernanke just to be a bit closer to it. So when Bernanke, when he did quantitative easing, the idea was that it would improve lending, which is completely impossible in the real world. Because you can't lend out reserves, but Ben isn't to know that because he's only a professor of economics and a Nobel Prize winner. But when they bought the bonds off banks, of course, banks can only buy bonds with their money because of the Great Depression experience. You weren't about to let banks buy again. Therefore, that's where non-banks came from. And of course, when the Fed bought bonds off the non-banks, it gave them money, which didn't earn a return. So they then would hope to go and buy risky assets. Now, normally that would mean shares, but I think a large part of the price boost we've seen post-quantitative easing is because of places like BlackRock now actually buying houses, buying properties, and both speculating on the price of them and also making them into rental properties, which of course squeezes out the actual home buyer who wants to buy a home to live in. So am I right that there's a fair amount of money from non-banks like BlackRock driving up the prices?
I have to agree with that. And again, the effect of when they have quantitative easing, the risk curve, you have to take higher and higher risk and be more aggressive on what you're doing to generate alpha. And I completely agree, Steve. I think that's part of what's motivating them to say, well, let's go look at real estate. And again, back in 2008, we're the firemen, or we're the arsonists. We create the fire, and then they turn into firemen and go out and buy big bulks of houses, and they crush. And that's a whole other deal. But for sure, I agree that the risk curve and again, I don't know. And if you look at the research, it's really fascinating. Is the secular stagnation story a part of the reason why R-star was so low? I really am fascinated by that question. What is driving interest rates to be so low in the 2010 to 2020 range before the supply chain disruption? And what was the cause of this recent inflation? Was it supply chain or something else? And so that's a really the juicy questions we're dealing with now. But back to your question, Steve, that I 100% agree with you that there is a risk on motivation because the rates are so low. They are motivated to take more and more risk, and it forces them to look into areas they wouldn't otherwise.
Sounds like Minsky.
Let's talk about Minsky.
Everything
Let's
sounds
jump
like
into Minsky. Douglas, you said earlier in the show you love Minsky. I mean, you've modeled. Tell us what you've modeled and why you love Minsky.
Well, in my background and to kind of how did I get here? It was essentially I was in the mortgage business when '08 happened, and I was looking at becoming a developer at the time. And so when things went pop, it's like, I just got hit by a bus. What happened? And who can tell me why I got hit on the bus? Because I'm looking both ways, I think. And no, I still got hit by the bus. And Steve was one of the, I think I saw a handful, maybe two, that said, Steve and Case Schiller and Dr. Schiller, that said, hey guys, there's a problem here. You don't see it. And it's like, well, I had a pretty great, and I really consider my undergrad education excellent. Really great professors. I got a really good Keynesian background too, which I think I'm lucky actually now that I understand the game of economics. But so I had a predisposition, I think, to Minsky from that standpoint. Also a law degree and a debate background. I'm literally like, oh, free trade, great, free trade, deregulation. So when '08 happens, it's like something in my model is not working here. And then so who else can say, who's got a model that I can start following that makes sure, hey, I really, from a big picture standpoint, we need to regulate this stuff. But also, second, for me, if they don't do it, because we know the system in the and again, I like to make fun of my Austrian bros, but one thing I do agree with them is crony capitalism. The degree at which getting regulation that would be sufficient is probably not going to happen. So how do I defend myself as Main Street against Wall Street? And this is one of the things you can do. You start thinking like Minsky, and you have a broader map than most people do. And so that's a part of what I believe is how you defend yourself against this stuff.
What have we got here?
So,
Okay.
so you're an Australian, not an Austrian, Steve.
Indeed.
I might want to make sure I read that properly.
I'll have to show Americans where the two countries are on the map and how big one is versus the other.
Good point.
Yeah. I almost don't want to see that in there in that statement. Like, how many people, just to use the term right at the beginning, would gestalt that association with an Austrian or a libertarian? Just make the assumption.
All the bloody time. It's just crazy. Yeah.
Right. I mean, because people just do the 2-finger scroll, right? It's just like, we love these.
It's the two brain cell thinking that worries me more than the 2-finger scroll.
Yeah.
So Doug, I got a question for you. For the average citizen out there, the decision to rent versus the decision to buy. How do you work your way through that? How would you advise someone?
Well, and again, that's where we're at. There's a wicked, savage difference between renting and owning right now in terms of the mortgage rate. So literally, it's a no-brainer almost right now. If you're renting or if you're able to keep nimble and go ahead and buy it where the current rates are, and again, if you're really responsible and you can handle this, buying on a short term and with the understanding in 2 years, I think at most a 2-year window where the rates are gonna have to come down. I don't see how we can. This is an unsustainable level personally. And again, we can get into the weeds on why I think that. But and again, talking my book also possibly. But I am cheerleading. But I'm also, I really think, divorcing myself from my interests. I think for academically, it doesn't make sense to stay this high. So really, right now, it does make a lot of sense to rent because just there's the savage difference between what your mortgage and rent would be right now.
So it's and simplistically for the average person sort of doing a brain calculation is just the delta between the two.
I think right now it's almost a no-brainer. I can't see how you can financially. And again, there's a good argument over the long haul. A home is not a good investment. Which Schiller did some work on that basically the return is zero. So anyway, don't think of it as an investment. Think of it as a product is kind of where I'm at on that. And that's a very good, we can get Dave Ramsey and we can bring in Susie Orman and we can bring in a lot of the finance folks and have a great debate about that. But it's a great product for your lifestyle. But again, don't think it so much as an investment personally, unless you're looking at the rental market and doing rentals. That's also another thing I'm less inclined to argue it's a good personal investment in your home.
Look, I want to change the gears a little bit here because Douglas, you brought up this idea of you see nothing but an upward trend because we're kind of at a bottom, I guess, and so it's not sustainable. And in your view, to go down further, and we can get into a lot of that. But what I want to actually throw out and get people to think about for a minute is, what about collapse at that sort of thing? I mean, as a fund manager, you're not betting on the long tails, right? That much. And it's really hard to really do that. But for clients, how do you process those kind of extremophile risks? Because it must go through your mind that something might really just wipe the market sideways.
Yeah, and that's why I think real estate actually is still a wonderful way. There aren't a lot of ways to become independently wealthy in America, but real estate is still a solid way of doing it. You get so many tax benefits. And if you do it right, and again, it's how you do your debt drives the entire discussion. So your number one risk question is, well, is my debt long-term, or am I being realistic on, my assumptions on the pro forma? Are the rents, am I creating a number or a story, or is this like actual? Am I underwriting on actuals? So having, and I've talked a lot of smack on some, apartment syndicators, and what they didn't do is they didn't manage their risk. And so if you can manage your risk by longer term debt, or having a rate cap at the very minimum, you can still be very successful in the real estate market. And that's why I think it's a lot easier. And frankly, I think the stock market is wicked hard. There are some people that can be good at it. But now we've got computer algorithms and PhDs in astrophysics, and that's your opponent in the equity market. Do you want to play against that guy? Or I hate to say it, the average real estate investor doesn't have to be that smart, and that's part of what's great about the real estate investment. It's just, if you do the right things with debt,
also why real estate is an incredibly destructive thing for an economy to get fixated upon.
Right.
Because what you have is people are just gambling and speculating on asset prices, and what they're actually doing is gambling and speculating on the level of leverage people are willing to take on asset prices. And if it's okay to talk about it in like an individual and episodic attitude, which is what you're pretty much doing. But when it becomes systemic, then it'll be a bubble and it breaks at some point, or the bubble will take away resources from more potentially productive uses. The extent to which people these days are gambling and speculating on whether the house is going to increase or decrease in value. That's where the brain cells are going, when it should be on what new innovative product can we create here. And so I'm really just a critic of letting, the deregulation didn't deregulate the manufacturing sector. It deregulated the speculative financial sector. And so rather than giving us the so-called benefits of deregulation, we turned the place into a casino, including your own home.
And made it addictive and made it systemic, right, Steve?
Yeah. Ty's going to put up a chart in a moment. You're talking about how these interest rates aren't sustainable, Doug, and it's worth looking at what one of the impacts is. So here is the bank credit. That's not total credit, but private sector bank created credit. And you can see it's been rising away. We had a bit of a fall during the financial crisis. Now notice it's flatlining. And the next chart will be the percentage change on an annual basis. And you can see that it went sharply negative after the financial crisis, and it's negative again now. So this, I think, is the impact of the high rates being maintained for as long as they were. If you take the MMT position, and you'll see Warren Mosler arguing this quite well, that increases the income for people who buy new bonds. So it's actually a cash injection into the financial sector. But what it does to people who want to take out credit rises as much as the reserve rates do, if not more. And therefore, you're suddenly going to get creamed if you buy illegal investments. So people are less willing to borrow, banks are less willing to lend. You now have negative credit, and that's going to undercut demand.
Well, and to that point, I'd love to hear Mike talk about the Phillips curve, because the Fed is still driven by some Phillips curve notion in some kind of demand side argument. And again, love to get into the supply shock side of things. And Mike, I'd love to hear you get on and see your thoughts on how the Fed might be misthinking about this problem.
Don't use the word might be. What you said might be. That's two wasted words.
Well, certainly if you read what the Fed Board of Governors are saying now, is that it's looking like they are going to begin cutting. and they've stopped raising rate. We don't know for sure, but that's what it appears. So I would anticipate them rates going down. Yeah, I mean, a lot of what happens in our economy is a function of the sort of mental models that the decision makers have, and these things are hard to get rid of. I mean, you went to school and you learned Keynesian economics and a Phillips curve, let's say, and that is in your head, and trying to not think of that when you're in these meetings and deciding what to do is often difficult, I think. So I think therein lies, changing the narrative in your head and your view of the world is just difficult for some folks. And I think that these institutions in the United States, the Supreme Court, the Fed, that are allegedly not politicized, that they don't watch the newspapers and whatever, I think that's nonsense. I think they are also influenced by political matters, election cycles, what have you. And so I think it's kind of a smearing together of all of that leads in the end to what pops out on Wednesday at 2:00 when the Fed announces its decision on rates.
Mike, I want to throw something your way. That same boardroom. Imagine you're in a boardroom, and the CEOs are smart individuals, right? And so if you explain, well, I want to give them their due credit. In their area of specialty, a lot of them can be really, really smart.
Smart and
right?
not at all deluded. Yep, okay, righto. Yep.
No, but the deluded is what I'm trying to propose, right?
Yeah.
Because one of the things is that, you walk into that room and you show them that their mental models, or you explain to them that their mental models are flawed. And you say, here's this better mental model, right? Answer the question, what is in it for me? How do I get competitive advantage?
Getting people to change.
Not just that this is the more accurate view of the world, right? This is a game. The game has been set up, and this is how we play. So tell me as a CEO, if I change the mental model with this, will my Q4 earnings increase or decrease? Well, actually, this is the language you have to explain.
We got an interesting question earlier on about delinquency rates. And I'll actually pass this on to Ty as well to see if he can whack it up while we talk. So this is a chart on delinquency rates in United States commercial real estate right now. And in fact, you look at it and you make sure, delinquency rates are really, really low. Maybe that means it's a safe investment. But the old pride goeth before a fall story. When you have an extremely low rate of defaults and delinquency, it might be a warning, holy shit, all hell's about to break loose. So if you take a look at this chart when it pops up on screen, there is an enormous rise in delinquency rates reach really, really low levels, historically unprecedented in 2006. And then bang. Okay. So not as high as earlier times, funnily enough. I'd actually like to look at more data on this front. But what you can see is that a low level of delinquencies can be a harbinger of something big is ahead of us.
Yeah, in the multifamily market, 100%, Steve. There are cracks in it's why I'm kind of concerned about the Fed is not really talking about it, or not really, kind of poo-pooing the problem. I think there's a significant problem in the multifamily sector right now, and again, I hate to be a black helicopter guy. I'm like, why are they not? And again, part of their job is to cheerlead. I get that, but I don't think you can say the commercial real estate market, especially multifamily and some sectors of office, are healthy by any means.
Mm-hmm.
So circling back real quick to this issue of Bill Phillips and his curve, right? And then you get a long run Phillips curve, short run curve, and Friedman's '68 presidential address, and Phelps and all that stuff. Bill Phillips, first of all, was an engineer, electrical engineer by training, and a New Zealander, right? And he, a good friend of mine, also an economist, Bob Kavanaugh, is a Kiwi, and he was a student of Bill Phillips, so he kind of knew him a little bit and has stories. And he said, Bill Phillips went to his grave dismayed that he was remembered for a little bit the Phillips machine, but really the Phillips curve. And he said, I did that on a weekend when it was raining and I had nothing else to do. I was kind of goofing around, and he didn't even want to publish the paper first. And the story is that James Mead, on his behalf, sent it in and said, this has to be published. And he was kind of like, this was just kind of a goofing around thing. the thing he really thought was important was he was reading after the war about Keynes and this new macroeconomics thing, and how Keynes was saying, no laissez-faire, that the state, the government, has to act as a buffer stock, as a stabilizing agent with its fiscal policy. And Phillips said, we don't really want people, he's an engineer, we don't want people just using their discretion, we want some rules. And he offered PID control. In engineering, when we stabilize a system, we use proportional, integral, and derivative control. And he showed how the government, now he was doing it on the fiscal side, but you could do it in principle, I suppose, on the monetary policy side, and have rules, right, that are there to stabilize the system. And of course, that was completely ignored. But there is still a debate about rules versus discretion. But he didn't. His own Phillips curve, he was kind of like, I don't know. And by the way, just as a little aside, his paper on the Phillips curve I read was the most cited paper in economics in the 20th century.
Wow.
Well, that's the only thing I can say in favor of how he's been mistreated, because at least people are never going to forget his name. But have they ever denigrated him without knowing what the fuck he was talking about? Because you and I know, if you go back to his 1954 and 56 papers, he was building the world's first system dynamics models in economics. And what he was taking is engineering diagrams, circuit diagrams, and then repurposing them fundamentally for saying we should build economic models like this. And not only did he build the Phillips hydraulic machine, I'm not aware if you're aware of this one, Mike, he actually built an analog computer as well. I don't know what's happened to it, unfortunately, but he made an analog computer model of the economy. So the guy was inventing computers before, in that sense, before computers. A remarkable human being. And other stuff about Philip, which really gets my goat when anybody criticizes him. This guy was a prisoner of war in the Second World War. He hopped on a boat to go to Japan. I think I've forgotten what the reason was. Ended up being on the boat when the war began. They were captured, and he ended up in a prisoner of war camp. He stole components from the office of the prison, the camp commandant, so that he could make a radio, so that people could listen to the BBC reports and other, and Voice of America, I presume, as well, rather than being told the glorious victories of the Japanese command, etc., etc. So people could actually hear what was happening from the other side while they were in the prisoner of war camp, which of course incredibly boosted morale. He also stole other components from the commandant's camp, so he made a hot water heater, and when the lights went out at night, he would then use the lull to heat tea, hot water for people to have tea inside the prison camp. Now, this man is a hero, absolute hero, and to see him denigrated because the Phillips curve is dead. First of all, these people haven't read the bloody paper. You and I know that he had not just the one element which he had, which was the rate of unemployment. He also said it's the rate of change to the rate of unemployment and cost push presses. Okay? So he was much, much richer than I've got to use a French, the fuckwits who are putting him down these days. Yeah, he's a great human being.
Yeah, he died relatively young, and they think it was because he was so malnourished during his 3 years in the POW camp that it impaired his health, and I think he died at age 63.
And goes from the half shell. Ask a little question, which is worth elaborating. Didn't he make an airplane? Not sure about the airplane, but when he was on the prisoner of war camp, he was an island in the Pacific, and he found the shell of a hollowed out bus, and he was working to make the bus into a boat. This man was remarkable.
And he used parts from a Lancaster bomber to make the Phillips machine. We had a picture of it there just a moment ago. So clever guy. Yeah,
incredibly so. He's the model of what economists should be, and to see him being put down to the Phillips curve as dead esophagus, they have no bloody idea who they're talking about or what he even wrote. Most of the ones about the Phillips curve, it's what's dead is the way the neoclassicals have abused his concept, because the basic idea behind the Phillips curve is that there is a power struggle over the distribution of income, and if the source of power for the workers, and this is back in the days when we had trade unions, is the level of employment. The higher level of employment, the more power workers have to bargain for part of the increase in productivity in the economy. Same thing applies to oil producers, raw materials producers. They're much more they're not as controlled as manufacturing prices. So when there's an increase in economic activity, you're likely to get an increase in wages and an increase in the cost of raw materials, and that's completely sensible. So again, even just to denigrate it is just totally clueless.
You stumped me for a minute, Steve. I'm just catching up with that.
I have an ethics. Oh
no. Here we're gonna do top chatters, and Douglas, just to give you a little bit of a primer warm up, we're gonna ask you to read through the top chatters, and the advice I give you is to just commit, try and go quickly, and if you flub, just keep pushing through it. Own it. Go, man.
Okay. I can't read the first one. Hyde was the last name. Carl Smith, Wyndham Estate Managed. Zero Dependence, Alex T. Bruce Constantine, Justin Raj Anthony, Tiffany Hart, Economics in One Lesson, Tony Wilson, Post-Crash Economic Society, Gunny 1972, John Watson, Ghost on the Half Shell, Philip M., Nighthawk Williams, The Real Charlie Bucket, Mouse Envy, Lana Del hates the clock, D. Smith, Johnny, Positive Economic Reform Ideas, Mad Max, TR, Stephen Aubin, Sales Stiletto, Creative Global Funding Services, Mandy Moorhall, BWNSFPTV, Stephen Hinton, Acu Music School, Connor Howell, Boy Howdy, Winston Redford, Annette B, Larry Summers, Secular Stagnation joining us this morning, Morning Gal, Manaraham, McFly, Multi-Eurox, Political Economy 101, Steve Frith, Botched Mandela, Kristen Watkins, Murray Krause, Galbart, Dart, okay, Patrick, Dry Guy, Rick O'Brien, Andrew Green, Brownie03, Matthias Zidane, and last but not least, Igor Insanik.
That's really interesting. I love Murphy was an interesting one because you haven't seen it before, right? Like we have, like as Mike would say, we're path dependent. So we're looking at this, we see Murphy, but you looked at it and saw McFly, right? Which I can see as you were saying it. I was like, oh, right. Yes, okay.
Got a nice question here, by the way, from Algo Rhythm. Is there a model of the Phillips machine in Minsky? No, there isn't. You could try to make it, but the reason I haven't bothered is that the original, the hydraulic model was actually putting together a multiplier accelerator model as a dynamic system and then using water flows to show it in continuous time, whereas the way that it was normally done was an equilibrium system. So it shows the advantages of a computer over a physical model, because when you build using water and flows between one reservoir and the rate of flow and so on and so forth, you're actually putting a specific model into hardware, and therefore you can't change it. You can change the parameter values, but you can't change the structure of the model. Now, I happen to reject the multiplier accelerator models completely as a basis for modeling economic dynamics. So it's unfortunate that that's what he chose. And I wouldn't bother trying to build that model because I think it's the wrong model to begin with. I wouldn't put it in Minsk, but you could. If you want to have a crack at it, go ahead, give it a try, but you must be using a continuous time. Oh, you have you? Oh, Ty has. Okay, Ty, pop it up when you can, mate. So you can do it, but it's a false model of capitalism.
So, Siklori Economiche, I'm not sure how to pronounce his handle here, his or her handle, is suggesting a lot of data sets, probably plots, and I'm going to guess they show cycles, including downturns. Mm-hmm. And one of the things that leaps to my eye, a more general thing I see coming from these suggestions, which is something I try to tell to my students, is, absolute numbers tell you things, but relative numbers tell you much better things. And so, if you give me a number and you say it's big, I'll say, but relative to what? Give me a denominator. So we look at ratio. So I think it's a good sort of rule of thumb when looking at economic data, housing market or whatever, is to always strongly consider a relative measure rather than an absolute measure. I wouldn't entirely rule out absolute measures, but relative measures are often more insightful. And I think that's what Cicluri Economice is kind of
but there's actually
behind what some of these things he or she is suggesting.
But there's one that'll come back to that, mate, which is one of the most important phenomena of the Great Depression, was that the level of private debt compared to GDP rose right out to 1932-33. And the reason it rose was that debt was falling more slowly than GDP was falling. Debt was falling at about 10% per annum, GDP falling at 20%. So the debt ratio rose, even though the level of debt was falling. So one thing I often do is you've got to decompose the debt and then look at the change in debt and divide that by your GDP, and then you can see it going from positive to negative.
Yeah, I say that's a great point. Yeah, because you got two moving things instead of one, and so looking at the change is also a great rule of thumb or good idea. Thanks for that. That's a great point. Yeah.
Yeah,
oh my
and
God,
Steve,
I don't use you conceding so easily. I'm waiting for a comeback here. Because I must say, I'm the amateur.
That's a good point. I got nothing.
and that is Mike doing a Keynes. Okay. When I get the information, I change my mind. What do you do, sir? So top hat for you, mate. Yeah, because you've got much better training in system dynamics than I have. This is quite ironic because I'm pushing Minsky all the time, and I built it, on the concepts of system dynamic software. But I have no training in the area where you've got oodles of training. That's why I'm trying to recruit you to start using Minsky rather than Bensim in your courses.
Well, I the way I like to think about it is toolkits. That it's not like I only use Vensim, I only use Stella, you have a toolkit, and each software package has its advantages and disadvantages. And when you need this, you use the right tool. When you need that, that I think that's the way to think about it, and not restrict yourself to just one sandbox.
Yeah. So the trouble is that we need a lingua franca for system dynamics. There is Modelica. Have you used Modelica at all to convert from one model to another?
No, just the various wizards inside of like Stella converts to Vensim and whatever, but or manually converting stuff.
I should take this opportunity to thank Mike for posting the lectures on system dynamics that dropped on your channel. Wonderful entree, and I'm really excited about what's going to happen on the channel for systems dynamics.
Oh, great! I'm glad somebody besides my mom is watching them. That's great.
Got to take a look at that. Actually, this is what trending cycles, isn't it?
Yeah.
That's the idea that we're trying to. First, teach people how to do proper system dynamics, whether you're using Minsky or some other. You can use Excel for that matter if you want to. And then secondly, how to apply it to economics problems properly in a manner that won't freak out an economist, at least a heterodox economist.
I think I want to point out something, and I don't know if this was Ty saying that Mike is the #1 system dynamicist behind Forrester. Right, so that's a compliment.
I was going to say, I'm not sure everybody would agree with that among my colleagues, including me. I'm a little skeptical, but I have my niche. Let me put it to you that way. So
good, yeah.
I still think the story that you tell, Forrester's like, hey, you guys should look at this, and the rejection he got from mainstream economists is still to this day. Like, obviously, you're too married to your thinking. That just blows my mind.
Like they're a religion. I mean, their capacity not to read what they don't want to know is just ridiculous. And that's why I don't know about you, Mike, but I'm getting angrier and angrier at the bastards as time goes on, because they've had half a century to wake up to this stuff, and they still cling to their equilibrium way of thinking, and they don't look at system dynamics. They won't look at data that doesn't suit their preconception. So it's a dangerous religion. I'd rather have a bunch of Iranian mullahs in charge of the world than any neoclassical economist.
Whoa. So what Forrester would tell me frequently would be that, he wouldn't tell me, he'd ask me, he says, why are you writing papers for economists? He goes, they don't care about the economy. They care about publishing papers in economics journals.
Yep, exactly.
And to get them in the top journals, they have to conform to a particular, set of assumptions or whatever. So he said, don't do that. He goes, write for the business community, write for the general public. They'll value what you have to say. He says, bother with the econ profession. It's useless.
Yeah. And Charlie Munger has the answer here, I think. And Munger once said, show me the incentive and I'll show you the behavior. And essentially, it's the incentive to change is there's too much disincentive for an economist to get creative because, hey, I might lose my job or respect my colleagues or I won't get published. And again, it's a vicious cycle. I've got to get published to keep my job and to advance in the career. So the career incentives, I think, are a big part of the problem.
100%. One time I was going into the coffee lounge, the faculty lounge at Notre Dame in the business school to get a cup. And there's this little group of economists off to the side feverishly working their way through Lucas and Stokely, which at the time was the Bible of rational expectation, sort of graduate stuff. And they're torturing themselves. And I go over with my cup. I go, what the hell are you guys doing? And they're, we're working our way through this. We want to build better rational expectation models. And I said, you cannot possibly think that people do that, right? You can't. And they're like, well, no, but that's how you get published. So we got to learn this stuff. They could care less about the economy or whether it was a good way to do things, but that's how you got journal articles published.
Mm-hmm.
Guys, I want to return to something that I brought up earlier about the abused CEO. I think I've been kind of mulling over it as we progressed through the show. And I know we took an adroit left turn, but I'm going to be so bold as to say that this is something that is a valid criticism against the Keynesian approach. Because I'm asking for something, a CEO to see value, and building on something that Douglas says, what's the incentives? We're focusing on the wrong meta here. The meta is, in private industry, what is the incentive for the CEO to adopt the correct model of the world? And it's a very specific question. That's a really important question that I think the tradition has a hard time bridging. The reason why I would say that is I think that it's focused too much on policy and focused too much on being that governmental lever puller. What do you guys say?
The funny thing is, you go ahead first.
Go ahead,
Mike,
Steve.
Doug, yeah.
Well, I was just going to say real quick that there is a similar thing to economists in terms of writing papers. I think there's a similar problem with CEO. If the CEO gets bold and takes a bold direction, he's getting very well compensated if he's in the States, by the way. So the incentive to adopt a new model is almost a disincentive in a lot of ways. And that's why newer companies can be more aggressive and creative, but older companies have, there's definitely a similar type of problem going on with CEOs, in my opinion. They have a way that got them there, and what got them there is going to keep them there for the most part. So they're not as open to new ideas, and that's my theory behind that.
I've got to actually give you this is actually to put some flesh on your question, Dan. This is a quote from Keynes, which I've just popped to Ty, and I'll whack it up on the YouTube as well. And this is Keynes about the very issue of can you actually follow his advice? He says, worldly wisdom teaches that it is better for reputation to fail conventionally than to succeed unconventionally. So even though you can say, well, if an unconventional model being therefore a Keynesian model will tell you to behave this way, I know that if you follow my advice, you'll get screwed by the market. So there's a real paradox there. It's what it means is if you have to have any way out of this in terms of a practical way of being a CEO, then you sort of have to apply the 80-20 rule. You'll do 80% of what the conventional believes and put 20% on what you think is the sensible thing. This is a great way of putting it forward. And you may then, you'll do well enough to be able to, not get kicked out of a job while the market is going in the expected direction. And then when the turnaround goes, you will suffer less than the others who are 100% committed to the market direction. So
there's a
deep-seated
wisdom in there, right? There's a deep-seated wisdom in there. But now I'm just want to focus on the delivery method. So the only possible, and Douglas, please, I want to pass the baton on to you because you're partially a legal scholar. You spent some time in law. So I think that's a fantastic way for philosophers. I think a lawyer and a philosopher are very close in modern times, right? Because you're arguing from the very limits of language. And normative understanding and societal acceptance, right? So the question is, why can't this, if this could be proven in a court of law, why couldn't it be legislated in constitutions around the world? I mean, I know that's so far, but in theory, right? If it has such strong legs, isn't that the play?
Well, and I really appreciate that. Then this is where the political back to the my I love libertarians, by the way, and I make fun of Austrian economics because I think it's not really economics, it's a political philosophy. But I do agree with them in the sense that there is there's a tendency for power to inundate the bureaucracy, for example. So there's regulatory capture is a very real thing, and so the incentive there again is back to they're defending their turf essentially, and so there's a momentum and gravity behind legislation and big regulatory structures where it's probably not what we want it to be, for example. And so a big case for me is product liability. And again, I'm going to show some of my leanings on gun control. It's a prime example. There's a one exception for products liability, and that's for gun manufacturers. So the political capture issue where we should have reasonable, and again, I personally think you should have a handgun, and this is my personal thing. I'm completely okay with that. But does anybody need an AK-47? And the legislation behind protecting manufacturers from that, from products liability that should be quite reasonably litigated, I think at this point. That's a part of the problem right there, is just the structure in terms of regulatory capture is my thesis behind why that doesn't happen.
Yeah.
So can I ask, there's a question from our audience, Political Economy 101 asks about affordable housing. And I love his or her Monopoly Man icon. So, that's excellent. But anyway, could you say a few words about, here we go, about the role that plays in the real estate business and what we should be doing, et cetera, et cetera. Because in my state of Massachusetts, it's a big deal.
Yeah, we got a couple of interesting dynamics going on, and it really plays out in the mountain markets here. You have Airbnb creating a supply, kind of like glomming up supply. So you have a couple problems. And also, we're looking at affordable housing. We like the space. There are some really great government programs to help finance affordable product. And the problem is you got a couple countervailing issues in terms of cost. So the cost of building affordable housing, that's why you don't see a lot of new just market rate coming on board, is the incredible cost involved. So you get public-private partnerships where say, hey, we'll give you some land, or hey, we'll abate your taxes. And then the HUD has a wonderful program called 221D4. It's a 40-year construction to permanent loan, which is great. The problem with it is it's an 18-month approval process to even get approved for the loan. So there are troubles in terms of addressing the problem. No one wants to do it out of their own, on their own sua sponte, as they would say. But there are some great incentives and tax credits. So there are good policies out there. But I think the problem is the cost structure is still really challenging. And then we're seeing insurance and taxes being an issue in Texas.
I'm a bit of a, I hate to say it, I'll call myself a Muscovite and leave it at that. But I follow a lot of the innovations coming out of that part of the world. And one intriguing one is the Boxable, the home builder called Boxable.
Yes.
And they're using a factory to make housing. And the basic idea is like housing is a bunch of boxes bolted together. Why not produce them in a factory and unbolt them on site? And the intriguing thing that particular firm has done is they've kept the width of the compressors unit to 8.5 feet, I think it is, which means it can fit on the back of a normal truck, and you can deliver the stuff without needing, when you move houses, you've got a, car in front, car in behind, all this sort of nonsense. You can move the damn thing at 80 kilometers an hour down the freeway because it's on a normal truck. And you then get to the site, and then you can expand it out. And in a matter of minutes, you've got, with a single module, you've got a freestanding single house, and it can go substantially beyond that. This is just showing how the construction is basically unfolded. So that may be the solution, because since supply is so difficult for housing, that's what enables the speculative bubbles that are built on top of it to happen. If this became the standard, goodbye that rigid supply. And that would be It's the only supply side solution to housing that I think makes any sense.
Well,
and we are seeing 3D printing. Mike, sorry to interrupt, but they do see 3D printing coming on too. So that's a really interesting innovation. I'm not sure if it's going to, I don't know. I'm interested and I'm curious to see how that plays out also. But I appreciate that, Steve. There are some innovations that hopefully will improve that. And building information models, essentially, maybe not quite prefabricated, but basically modeling it and building it in the factory and then shipping it prefabricated instead of cutting it on the site, which is normal. Just having basically an erector kit when you send it out. So that's I'm excited about that.
They have sort of like adult Lego sets that allow you to build a house with these blocks and stuff. But I was wondering, Doug, could you talk about a little bit about in terms of the supply side and housing, whether it's affordable housing or just housing prices in general, of rent control and environmental regulations that really prevent, it is argued by at least the orthodoxy, new houses coming online and hence the shortage.
Yeah, I do agree actually with rent control being a huge disincentive for landlords. That's a common complaint about California right now is the rent control in New York. It really is a huge disincentive to enter that market. And again, it's the wrong solution for a problem. It's a problem, and we can all agree it's a problem. But for me, it's a wrong solution, and that it just creates a disincentive for operators to enter that market. So I think that's I understand the spirit behind it, but I completely, personally, and again, this is where I'm kind of more in line with my brother in the real estate field, is I disagree with it as a solution. But again, the environmental regulations, and this is where I probably am very much lockstep with Steve, is that we're not doing enough with that. And so I'm really excited to hear what Steve's models with including energy and what we're doing and the cutting edge there. But for sure, I don't feel like environmental is as much a problem or a constraint other than, if you have a gas station, we need to make sure that you have incentive to build it and clean it up. And so that I think there's a reasonable job of that. I've had friends that have bought like dry cleaners, for example. I had no idea, but dry cleaners were incredibly destructive with the materials they're using. And luckily we have mitigation and people going in and mitigating those. And so I do feel it from a brownfield standpoint, there is pretty good structures in place to help keep that going along.
Okay, well, hold on just a second. I'm going to give Steve the opportunity to jump in and give an answer. Thank you. You steer the ship over to environment. We usually do that in the last half hour anyways, right? So that's great. I want to just encourage everybody on the engagement side of things that we're on Twitter and we're on LinkedIn and we're on YouTube. So, subscribe, engage, follow, all that sort of fun stuff. So Steve, can you jump into that and talk to us a little bit about environment?
Just in terms of regulations, I think you do have to have a regulated housing market because it has become the major vehicle for financial speculation. And that's not what housing should be about. So I proposed a long, long time ago, before the bubble burst back in 2006, I think it was, that we should limit the amount of money you can borrow to buy a house to some multiple of the rental income. Okay? And that would basically say, if you want to buy a house, my basic rule of thumb was you should, the amount of money you should borrow to buy a house should be no more than 10 times the annual rental income of that house. And that was before rents started to become ridiculous. Rents have almost broken away from incomes as well. So we've got such a tragically bad system that we have housing, which is 30 and 40 times the annual rental income, which is crazy. That's an extremely low rate of return, extremely high valuation. But we also have rents people can't afford to buy with their incomes anymore. So we're doing everything wrong. And it isn't a question to say we shouldn't regulate. It's what regulation would be more effective than what we've tried so far. And regulation that tied lending to the income stream of the property, not to some mythical idea about the income of the borrower. That'd be a major way to reform that one.
So Steve, I have a question about your the rental max or the rental multiplier. So if you look at a single family house, and then maybe we can switch it to a multifamily house, but someone wants to go and buy a single family house, and they can rent this house for $2,000 a month. Run through the calculation for me. Is it $24,000 a year multiplied by 10, or what
It'd be 240,000. Yeah.
is the maximum value of that house, right?
Yeah. Now, see, I've lost touch with them, but a New Zealand property developer established a website called Demographia. I haven't looked at it for ages, but he was a property developer. He built an enormous number of houses, and his argument was that it should cost no more than 2.6 times the annual income of a median wage earner to buy a house. So at 2.6, that was a reasonable profit for the developer, and he was speaking as a developer, and it's affordable for the buyer as well. So that's before you enabled allowed speculation to take over land values. And somebody said earlier, it's not the house, it's the land that's the cause. Well, the land price is driven up by the amount of money you're allowed to borrow to buy the block of land on which the house resides. So yeah, but his argument was that was a sensible level, 2.6 times. He said once you get past 3 times the income of the median house costing more than 3 times 3 years' wages for the median worker, then you're in a bubble. Now we're looking at up to 10 these days. So it just shows how sick everything is, and given how bad the house buying is, that's why people are willing to pay the fortune they pay for rent these days. Now, the chart that Charles just put up here shows the American data on household debt and house prices, and the top one, and you can see they're both rising. And then you look at household credit, which is change in household debt and change in house prices. Reasonably strong correlation there. The killer is the bottom one, showing change in household credit, which is the change in household debt and change in house prices. That's the extremely high correlation I was talking about there. And it shows that what actually drives house prices is change in the level of new house debt. And now that is not something that's down to supply and demand. That again is bankers abusing the privilege of money creation that they've got been effectively endowed on them by the state. And we do really have, I quite agree, the state itself is caught up in trying to maintain this Ponzi scheme.
So, Doug, if I can leap in here in light of speculative bubbles in real estate and them blowing off, do you follow China at all? And are there any lessons for us in the U.S. from the Chinese experience?
Well, and this kind of, there was a question earlier about, well, shouldn't this is the tension between central control and free markets, right? I think that what I would agree with 100% with Steve on is that we should regulate the finance side more importantly than even the real estate market. It's the debt, I think, is the real issue. And so you look at, tons and tons of empty cities in China that they just built it, and they're like, hey, if you build it, they will come. And so I think there's that distortion there, and I think that's where they led to the mistake. And again, because their system is such, they're making a bet that it won't. There's no harm in it, and in the private sector, of course, there's your consequences for building.
But the part of the reason why they did that was that when the 2008 slump hit, from memory, China's exports fell 46%. Almost instantly, huge collapse in demand, because a lot of the demand for China's goods was to put goods and services in American houses. Okay, suddenly, bang, that bubble collapses, then it cascaded back to China. So China's response, the government response, was basically tell the banks, and of course in China, the banks are pretty much controlled by the government, or certainly they're muscled by the government, and they basically were told to lend to anybody with a pulse. And you had a 40% increase in that year in the level of household credit in China. So, when you look at the rate of change of Chinese private debt versus the rate of change of Japanese private debt back in the 1980 to 1990 bubble, the rate of change of Chinese debt was 3 times faster than the Japanese, which was faster again than the Americans had at that time. So again, we're back in private credit causing all the trouble.
By the way, I should say that my question was based on a question from Stick Lori Economiche, so it wasn't really my question about China.
Right.
Just to give credit where credit's due.
What is this?
Connor's got a good question down here as well, by the way, and this is very true. Allowing interest-only loans. Fuck that. Okay, you take out all debt, you got to service. Because what this means is people say the calculation of whether they can afford a loan is no longer on paying back the interest plus principal, just paying the interest, and when the house is ready to be sold, it'll be worth so much more. And so people are putting all their, so we're pumping into the system up even further, making housing even more unaffordable than it was in the very first instance. Back when I made the mistake of trying to run for office in Australia back in 2022, one thing I looked at was a government policy document, I think from 1980s or thereabouts, talking about the purpose of government policy was to encourage a higher level of home ownership. You look at all the interventions they did, and every last intervention caused a lower level of home ownership. So,
I could see Steve on a street corner kissing babies trying to get votes.
yeah, exactly. Not my scene. I'd rather kiss the mothers. You can.
Right. And that's, my friends, why he lost. He was kissing the mothers and not the babies.
Not the babies.
You're right
yeah.
again. Yeah.
That's right.
Yeah.
Hey, Ty, I expect to be set up for that one next week.
Yeah, we gotta have Steve kissing the mother with the baby on the side, right?
Oh, that'd be great.
Don't make me out. You put me in Donald Trump shoes, you're in big trouble. But anyway.
Oh, yeah. Hey, listen, I one theme I have to point out is it's not the regulations, it's not the policy that seems to be the problem. It's all well intended, but sometimes it just gets messed up beyond belief.
Unintended consequences. I mean, this is the classic thing about economics, unintended consequences. And this comes down to not thinking about things systemically. And that, again, back to Mike,
100%.
I'm going to bat over to you. If you don't think systemically, if you take a particular component of the system and try to reform it, you will cause a bubble. And that's what we've been going through time and time and time again. And neoclassical economics is a great way to ignore systemic changes. Mike, take it away.
Oh, absolutely. That people do not do that. They focus. They do an atomistic or reductionist approach. They take one piece of the system that's having a problem. They do a massively deep dive. They come up with a solution and they implement it. And they are unaware of the unintended consequences that all the other parts of the system react, possibly after a delay.
Yeah.
And so you don't attach cause and effect because it changed here, and then only later does you see the change over here. So, I don't see that as having caused that. So yeah, it cries out for what we do, this sort of modeling. Before you go ahead and implement a big policy change that's going to affect a lot of people and a lot of things, maybe we build a model and try it in the virtual world first before we try it on the real system, right?
And like that, then that's been like my approach as well with Minsky, to design something where you've got to you try it in silicon before you try it in the real world. And I've lost touch with him, but there was a American guy who established a company in Britain who actually was involved in the military in Iraq. I've forgotten quite the role he had. His wife is Iraqi, so he obviously broke away from the American mindset. But he said when he saw the disasters involved in going into Iraq, he said he wanted to make sure that in future, before we do anything, we model it first and see what the hell are the consequences in a proper, well-designed system dynamics framework. Because so often people will say, this is the solution, bang, they go into a bloody campaign upon it politically. We end up with a total catastrophe. We then spend our time bouncing from the consequences of one catastrophe onto another all the way through.
So I want to share a quick personal story and then let Doug react to it. My personal story, then a generic statement, let him react. And that is, when I was a kid, one of my grandmothers lived with us. And if you wouldn't finish everything on your plate, she'd say, you eat that. During the Depression, and they go into a whole Depression story, or I want a new whatever. And she'd say, you use your brothers. During the Depression, we had to, and we were like, oh my God, another during the Depression thing. But she was so influenced by that. She didn't trust the stock market she didn't trust banks because of it. So now we go to a more present day. And after the internet bubble popped, what did people do? They were gun shy on stocks. And so they went into real estate. And then we got a speculative. So, and you kind of alluded to this earlier in our broadcast, Doug, today, that the experiences of people, these big sort of life-changing significant events can really influence their investment acumen, their investment tastes and preferences. Could you comment a little bit about that?
Yeah, for sure. It was really interesting this last cycle, and I think we're past it already, but do you guys remember the Bored Ape NFTs? It was so weird to see weird things like that bubble up with just kind of, in the meme stocks, for example. So it was really interesting to see the disconnect between the people that were older, and then this was also the demographics as Destiny story, which is another whole derivative story that's really interesting. But the disconnect between the people that were coming of age in this latest cycle and what they were investing in versus people that went through 08 were a little like, what are you guys doing? And so I completely agree, Mike, that there is a institute or like a group memory, if you will. I think that's 100% right.
I had a few little, let's get to the anecdote stage. I gave a presentation on my model of Hyman-Minsky's financial instability hypothesis in 1996 when I started a job at the University of Western Sydney. And I walk out giving the seminar presentation, a very nice, very dumb, but very nice neoclassical member of staff said to me, the difference between you and me, Steve, is I believe people learn from their mistakes. And I said, yes, Andrew. Yes, Andrew. And the other difference is I believe people forget and die.
Mm-hmm.
And like the extent to which
over a longer time period, absolutely. Yeah.
Yeah, they forget. And like for example, we talk about, people getting out of the stock market, go into real estate. Look at Richard Vague's research, brilliant research on the causes of the various financial crises for the last 1.5 centuries in the 7 major global economies. The 1920s bubble began with a real estate bubble. And you don't actually find it in the statistical data. It was missed out by the statisticians. He went back and found actual newspaper reports and found there was a stock market bubble and a bust, which was the beginning of the 1920s. So we do not hang on to the memory of these things in the way we should.
Yeah, and Steve, to that point, there's a wonderful book called A Bubble in the Sun. And actually, when we mentioned this lately, I went and found some papers, and there's a weird chart that overlays 2006 with 1926 in terms of housing starts and then a collapse. And so that story that there's a real estate collapse behind the Great Depression that nobody really, it's very rare. There's a couple papers, and Steve, I've got a list of them if you'd like me to send those to you. There were very few papers that I could find, but for sure, but a great entry and it's really well written for non-wonky folks like us, that A Bubble in the Sun is the name of the book. And I highly recommend it kind of as an entree into that area. And again, Florida real estate bubble, it sounds familiar.
Yeah, I've just put that. In fact, that's where Charles Ponzi got his start. Yes. in real estate in Florida.
The Boston guy.
Yeah.
And now, mate, you should read. There's a great book about Ponzi called Ponzi's Scheme, written by Michael Zukov, and it gives you the background of Ponzi as a person. And put it this way, he's a damn sight better human being than Donald effing Trump.
Wow, that's quite a claim there. Yeah.
Didn't he wear like a straw hat? He was all dapper and.
Yeah, but
it comes with such an association, right? Like when I say Einstein, that's cliche for smart. When we say Ponzi, it's cliche of like spam bubble or
Bernie Madoff or Sam Bankman-Fried.
To give you the background on his scheme, somebody wrote to him from Italy because he's Italian, an Italian migrant to Australia, Sicilian possibly. Somebody wrote to him from America, I think it was, or forgotten the direction, and they enclosed a postage stamp, which was a stamp you could take and redeem to get a postage stamp in the country you were in. And these things, the value of these, you could send a letter to somebody, America to Italy, and then include in the letter a token that you could then take to the Italian post office to get a stamp to send the letter to reply back to America. And he looked at the price you paid for these damn things, and they were all set before the First World War and before the currency upheaval that caused. So he realized you could actually buy these things in Italy far more cheaply than you could buy them in America. So he thought, I know what I can do. I'll raise money here in Boston to then go and buy these things in Italy and bring them back here and make a fortune. So that was the original scheme. And he couldn't get money. I know it wasn't a high bar. But anyway, I'm warning bloody Ty about what he puts up to satirize my deliberate comment a moment ago about kissing mothers rather than babies. But I should have some beer here, obviously. But anyway, see, he got the scheme going and he couldn't get any funding for it. So he decided to put an advertisement in the newspaper where he offered to give people, I think, a 50% return in 90 days. Okay?
Yeah.
And
That
then
sounds
what
about
happened was
right.
he was still trying to put the scheme together. He's actually trying to get it to work. And when he got to the 90-day point and he's supposed to repay people who'd give him, they're supposed to get 1.5 times the money back after 90 days or 45 days, I think it was. So all he did was he just reached into the latest lot and gave it to the earlier lot. And then the bubble took off. Yeah? So he was actually trying to do, it was an impossible scheme, but the amount of, the volume of these stamps was actually quite trivial. There's no way they could ever get it close to the valuation. But this is in Michael Zukof's book, Ponzi Scheme. I highly recommend it. And it's a great read, as well as an interesting human being. And I must actually one of these days put up on the YouTube my video of me visiting Ponzi's house, which I did about 15 years ago.
Oh,
Yeah.
sweet. Yeah.
You should do it as the new intro video, right? Like there's a there's an
true.
intro video. I think I don't know if it's up there anymore. If we took it down, but it was like an hour Minsky thing, and it was hard to
Yeah. Ghost
introduce somebody.
Ghost has asked whether Ponzi knew what he was doing. He wasn't over. He did realize it, and then he just thought, I'm going to ride this as far as it can go. And he finally ended up saying, as he got in his deathbed, look, I gave those people the best entertainment they've copped in their lifetimes.
Yeah, probably. Yeah. Okay, well, what's left to be said about real estate? Douglas, is there anything you think the audience has missed in terms of some of your deeper insights or your work related to real estate?
I think the answers are all related to what the Fed does next, really, and then again, trying to guess, are they going to get the, are they going to land the plane? Because I think we have achieved a soft landing, and so the question is, are they going to snatch defeat from the jaws of victory? And so that for me is like the economics related question to real estate right now is, are they going to stay too high too long where things do start to break? And I'm really concerned, frankly, right now that they're not going to pivot anytime soon. And so again, they're making noises. What I do think is they're pretty much broadcasting, and I'd love to have Mike speak to this also, is it will be a regime of consistent cuts once they start, is what I'm reading from what I'm seeing. But that's really the big question.
Yeah, I agree. From what I'm reading as well, I think that's what the plan is. That's what the Fed is signaling. I think it's just when they're going to start, and they've pretty much said we've stopped raising, and we're going to be lowering. It's just when, and they're not going to do it. They're not going to just plunge it. It's going to be I think 100%. So one thing I'll say on a more personal note with respect to the real estate market is I'm a woodworker. I have a big barn in my yard, which is my shop. And I'm actually at a desk right now that I built for myself, but it's not made out of mahogany or something exotic. It's made out of 2x4s and plywood. Why? Because when I built it, lumber prices were through the roof. It was ridiculous. And so, the lumber was like, I'm trying to remember, it was like $9 for a 2x4. It's normally $2.75. Mahogany or any of the exotics it would have been a $6,000 desk. And it's like, I just want to put my crap on it and write. I don't want to, not making a work of art here. So, and now of course they're down, but the housing market it's not the only thing, but the housing market is one aspect. And then the Fed influencing the housing market on lumber prices for me. And
I got to add, Mike, the trades, I'm really worried about the incoming, and the trades are really becoming a real concern about labor force being competent and continuing, because we have the aging out of some older contractors and getting a new supply of trades. That's another, and I'd like to add on to that too, is the supply inputs and then the trades I'm really concerned about as well.
Oh, we share that. I did my doctoral dissertation for like 40 years ago on the impact of vocational and technical education on the economy. And I'm a big believer in learning how to build stuff. Even if you're not going to be a professional plumber or something, you should know how to unclog your toilet and change a faucet and swap out a toilet, or do basic electrical, basic carpentry. And I'm trying to get my grandchildren to go that route in the technical school. And you can't, by the way, you can't be an idiot and be a welder or something like that. Right. Or if you can't do math, you can't be a carpenter. You got to take measurements and, so it's not like the blue collar people are dumb and no, absolutely not. And by the way, you can make a darn good living if you know the trades, and you could just be a tradesperson, or you can start your own business and you can, supervise the plumbers. Or if you're clever, you can invent a new doodad for plumbing or electrical or whatever, patent it. There's all sorts of routes. And you might know of a personality here in the States, a Mike Rowe, and he has a scholarship fund now, Dirty Jobs, and they help kids learn about the trades and how useful it is to go into that and earn a good living. And they have scholarships. And then he interviews the young people and they say, "What do you do?" "I'm a welder." How old are you? 22. How much money do you make? Oh, well over 6 figures. I own my own house. I have a car. What do you weld? Oh, I weld aircraft parts. I learned to weld. I don't have any debt, and it's like, see? And I love going to work every day. It's so much fun. It's interesting. It's challenging. So yeah, 100%. Absolutely. The trades and the U.S. has got it wrong. Somebody decided everybody should go to college. Now, I'm a college professor, so I'm kind of shooting myself in the foot here, but everybody shouldn't go to college. Some people should. And for certain things, you really do have to, but not everybody. Everybody's got to think a little differently, I think. And
status take over rather
than Germany has it right. They have that Voki Tech track in cahoots with industry, and we don't do as good a job in the U.S. on that.
No.
Yeah. No,
what I like about Douglas and probably fund managers everywhere, but let's talk about Douglas for a minute, is that I think to be a successful fund manager, you have to look at so many variables and not just take them into consideration, but almost intuitively assess or risk assess them, right? Like, how relevant is this weight of evidence in relation to the bigger picture of the fund or the health of the company or the group of companies? Would that be a fair statement, Douglas?
100% agree. And now Taleb is wrong about banking and money, but he was really great in terms of opening my eyes in terms of thinking in terms of tails and downside risk. And so when you start thinking, and that's my favorite concept that you don't learn from a blue collar kid. My dad was a truck driver. My mom was a hairdresser. Really world-class fund managers think in terms of asymmetric risk. And so asymmetric risk, when you're looking at your upside versus your downside, that's probably the core thing that anybody, if I could teach anything to, any investor that's, just trying to manage their 401k and look at their retirement, am I taking good risk relative to the reward? And so the asymmetric risk is really the core thing I try to teach Main Street in terms of how they proceed.
And so,
Mike, did you see that image a moment ago with the guy welding by taking off the goggles?
Yes.
That is the most recently deposed Australian Prime Minister.
Okay.
Calling him a fucking idiot is an insult to people who fuck or are idiots.
Jeez,
are you kidding me? That's your Prime Minister?
That was the previous Prime Minister, Morrison. Probably the most loathed person in the country these days. Total bloody moron. There he is.
Born without the
doing a photo opportunity. Sorry?
I said he was born without the common sense gene or something. Like,
what did he run on? Steve? Like, what was his talking points that won him the?
He's the reason we have a Turkey as the chairman of the OECD these days, because what the Australian Conservatives would do. Australian Conservatives are called liberal, by the way, just to confuse Americans. Okay, yeah. But what they specialised in was working out how to cobble together a winning coalition by giving various little subgroups what they want. So the collective number of people, subgroups voting for somebody gets the person into power. So like the last person you'd want in charge of the OECD right now is a fossil fuel championing denier of financial instability. That's what we've got, Mateusz Korman. And he got the job with Morrison helping him get it by jetting around America and around Europe and Third World, the Middle East, and so on, making the case, seeing what each little person voting for the chairman of the OECD wanted, and cobbling enough votes that Morrison won, shooting down a European woman who was likely to win instead. So Morrison did the same sort of thing himself to get elected back in 2019, I think it was. But then he was such a jerk, such a total jerk, that he lost in a total landslide on the other side. So one of the worst things you can do if you're a moron, don't win, because you're going to lose pretty badly sometime down the track. And he taught Boris Johnson everything he knows, and Donald Trump, he could use that particular rod.
That's hilarious. I actually had in my mind, we only have 5 minutes, guys, left. So I want you to start thinking about how you can say something really intelligent or thought-provoking to the audience. But I was thinking, like, that was a play-by-play, right? That was a really long-winded answer. I was hoping it was going to be something like, gay rights or free parking for the so-and-so or whatever.
No, he just managed to get, what are the voters in the suburban fringe want? What do the voters in the inner city want, et cetera, and just give them, promise them enough of what they wanted to get elected. And then we saw what a total bloody moron he was in charge of the job.
Wow.
He just recently resigned from Parliament. And, the collective, the best thing to improve Australia's mood in general is when his resignation was announced. We don't have to put up with a jerk in Parliament anymore.
Yeah. Well,
so
okay.
Doug, you made a real quick here towards the end of you made a very quick but important statement, I think, a little earlier in today's show, and you talked about demography is destiny. I suppose in real estate and in general. Can you elaborate on that a little bit here at the end, because I think that's very important.
Well, thank you. I really am interested in how that affects and learning how to model, and what we do and moving forward and where we're going to go is try to, how do we use system dynamics, the effect on how demography and so like think about the millennial spending pattern. So how that really comes into play, and is the millennial spending patterns and also the boomers and aging out, and so they have a ton of savings. So is that part of why the interest rates are so low? Because we have a savings glut. So you think in terms about
no, we don't have a savings glut. I'm sorry, we do not have a savings glut. This is neoclassical thinking. So get that one out of your head. The only way you have a savings glut is because the government creates money which turns up in your bank accounts. Okay, people can't save money into existence. So it's so easy to fall into the neoclassical mind traps, and the savings glut is one of them, along with secular stagnation.
Wait a minute, Steve, I don't understand. So I can't say I can't. I've got a mental model that's flawed because I'm saving monthly in my bank account.
Yeah, everybody. This is where people put the individual to the collective. An individual can save money, okay, but the people themselves, the aggregate, cannot save money unless money is being created by the government by running a deficit. That's the only way the aggregate level of savings net of loans can go up. You can also save money by borrowing money from a bank and then putting that in your bank account. So your bank account can expand that way, but it expands exactly as much as your debt is. So
fallacy of composition.
Okay, you guys heard it here. We started off today's show with Mike's hammer, and then we ended on a expanding fat wallet. So there's your sandwich. You know what? Go back and watch it because we're out. Thanks. 30 seconds early. Bye-bye.
Bye.
I'd get Taylor Swift to endorse my hammer.
No! God, please, no! No!
I'd get Taylor Swift to endorse my hammer. Taylor Swift, Taylor Swift, Taylor Swift.
Taylor Swift.
To endorse my hammer. To endorse my hammer. To endorse my hammer.
Endorse my hammer.
Oh, I didn't even think of that. Come on now. Oh.
I didn't even think of that.